270s. What's this?
Open interest
Volume over. Jesus Christ. All right. So I think this is a FOMO contract because a lot of people saw people buying those March 19th contracts for the 21st. That's February.
Oh shit.
Yeah. All right, so
Yeah, there was like a shit ton of $1 million orders and contracts.
yeah, I saw this. What strike was it? Was it the 250s? Has to be. Yeah, look at that volume over open interest. Yeah, these are just banks playing around. Not much going on. I mean, obviously, don't buy the 230s. I mean, unless you guys want to pay $4,000 to make like $5. But yeah, the 270s. Yeah, it's pretty high volume and high open interest. So it's not unusual. But a lot of people are interested, obviously. So yeah, I mean, also guys, one thing to always look at the put volume open interest versus the calls, right? I mean, I've been focusing on the calls all day, but if you guys look at the puts, you guys can see how we clearly have a lot more people holding puts. So this just from the option, this options, what do you call it? I'm blanking right now. Those options chart, you know what I mean? The lineup.
Option chain.
Jesus Christ, what's this called?
Option chain.
Option chain.
Thank you, option chain. Oh my gosh. Jesus Christ. All right. Yeah, looking at the option chain, we can see how there's actually a lot more put interest right now. It's very, very heavy on puts.
21 times.
Yeah, people are expecting it. I think so. We might just get some pullback in BABA short term. I mean, chart wise, I still think the stock is gonna tank, but I don't really want to go over charts right now. Yeah, we'll see what happens. Always also for earnings, looking at the open interest on puts and calls. If you see like a lot more calls on a lot more things on the call side versus puts, then you guys can probably guess that the price might go up after earnings. But don't use it as an indicator because sometimes a lot of banks will actually buy calls up into earnings, and then at the very last second they'll just switch to puts. And open interest is not updated throughout the day. Volume is, but open interest will stay the same from market open until close, right? It just moves too quickly, obviously, to calculate. So, yeah. What's this? Yeah, the bid and ask spread is the difference between what people have to spend and what people want to get, right? So it's basically just supply and demand. All right. So if you have lower open interest on the contract, you're most likely going to have a bigger spread. If you also are trading tickers that no one wants, you're going to have a higher spread, right? So if you guys look at the two-step, oh, you can look at Baidu. That's fine. All right. So you guys see that spread right there on the 146 call? So we have a $30 spread. It's not too bad. It's not great, but you know, it's fine. The best contract right now is 150, right? For a couple of reasons, right? The gamma's in a good spot. Theta's a bit lower. We have a tight spread. 345 to 355. That's the best contract on this chain right now. If you want to go long on Baidu, your best contract is a 150. Your second best contract is the 149, and the others are pretty bad. The 155 might be good too, but as far as open interest and volume, the 150 strike is the best. And then on the put side, your best contract is definitely the they're all pretty crap. I'd say the 145, yeah.
Yo, Craig. So when there's a big spread, like let's say you get in a stock and there's like a dollar spread, you're automatically losing like $100 before you even get into the contract, right?
Yeah, I mean, you're not really losing $100. I mean, it'll show up as minus 100 the second you buy it. Let's find an example. Look up Shopify because that one has garbage spreads all the time. All right, so if you guys are checking out, I put some more strikes on that. Let me see like more strikes. Those are way too expensive. I can't do more than 14. That's annoying. Let's look at the 1,000 strike. Let me see. What's ridiculous right now? All right, the 1,045. Right, look at that one. All right, that 1,045. The calls. You see that spread right there? $40 and 185. So that, yeah, like you're saying, right off the bat, if you buy 10 of those contracts, you're going to be down 185 minus 40 is, Jesus Christ, 135, right? That's definitely wrong.
Dude, I never even thought about this before.
Really? Yeah, you have to consider all of this, right? So, yeah, if you buy 10 of these contracts right now, you're going to be down $1,450 immediately, right? Because the highest price that someone's willing to pay for this contract is $40, but the highest price someone is willing to let go of it is $185, right? So if you buy these contracts right now, you're just going to lose, right? This is why I always get a little annoyed when someone makes a call and then they'll buy a different contract, they'll lose money, and they'll wonder why, right? If I pick a losing contract sometimes and you pick a different strike and you don't consider all of these factors, you will lose money a lot more quickly than me, right? So I've seen it before where I might make like a call. Let's say I buy a 150 strike on something, and then someone's like, okay, I can't afford that, so I'm gonna buy 151, right? Then the stock drops $1 and I'll lose like 3% in value, and that person loses like 27%, right? And now when I'm down 15%, I get all these DMs, and they're like, okay, this trade, I've lost half the value already. Well, you didn't buy the contract, right? You didn't buy the contract I told you to buy. See, I check all of these things before I make any trade. And if you guys don't check this, you'll actually be wasting money, right? So whenever you have a stock with a high bid and ask spread, the easiest thing to do is to just not trade it whatsoever, unless you are expecting a big move, right? So right now the best contract here on Shopify is obviously the 1,050, because we have a $20 spread, which is not great, but it's the tightest spread we're going to find on a stock as expensive as this, right? Again,
You want to try to fill that on the mid, right?
yeah, but you're not going to get filled at the mid, not with a contract like the 1,045. I mean, 63 open interest, like it's not happening. You know, it's not happening. Yeah, I mean, getting filled at the mid is nice. I mean, technically the midpoint between 40 and 185 is, I'd say somewhere like 115 or something like that. But it's not happening. It's just not going to happen for you.
Well, not to be subject, but what Costa's doing right now with that little slide bar right there.
Right.
You go to sell that contract, that thing's fluctuating left and right like crazy, and you're trying to get out. So is there something you can do to like set that so where you get out at what you want to get out at?
Yeah, I mean, you set a limit order, right? And you can always choose what price you get out at, right? But if the contract never reaches that price, then it's not going to happen. Like, you're not going to get magically filled. Remember, every single thing you trade, if you sell something, someone needs to buy it, right?
Right.
Yeah. If there's no buyers, you can't sell it, and if there's no sellers, you can't get it unless you pay a jacked premium. At what point someone's going to eventually let it go.
So the best thing to do, obviously, is if you're trying to get out, you want to get to the 120 to get out rather than the 110 because you're going to be making a little more.
Quite the opposite. If you're holding a contract and you have a lower bid, you're going to get out at a lower price. So if you bought something for 120, but the bid price is 110, you're not going to get it filled at 120. You're going to get filled at 110 and you lose $10. Okay. So you buy it with the expectation that it's going to move. Yeah, because it doesn't matter how much value your contract has. If no one's willing to raise the price for it, it's just not going to get filled. So.
Okay.
Yeah. All right. I think that's enough for options. I did say I was going to go over some exit and entry strategies. I'm not going to spend too much. It's going to be a 2-part lesson because it's honestly a lot, and I don't want to overload you guys' brains anymore. So, yeah, we can either do that or we can go over some charts for tomorrow. You guys can choose. Just vote in the chat. What do you want to do? We can do some indicator stuff and like live trading stuff, or we can just do charts. Just put it in the chat. Thank you.
Let me stop the recording here.
Indicators. All right, we got 1 vote out of 8 people.
Indicators have to go too, bro.
What was that?
Indicators up. I'm cool with too.
All right, 2 out of 8. Then the people said indicators. All right. let's see, how do you want to do this?
Want to pass you the screen?
Not really. I should have planned this better. All right, let's do it this way. All right, well, honestly, guys, the whole indicator lesson I was going to give does require you to have a basic understanding of all the indicators that I'm going to use. It doesn't really make sense to teach my strategies with the indicators if you guys don't know what the indicators do or how to use them. So, obviously to become a profitable trader, you guys do need to do a lot of reading and a lot of trial and error. So what I'll do, I'm gonna go through some indicators, and I want to see if you guys just know what it is. It's not a test or anything. I just want to kind of gauge where you guys are at, because if you guys aren't really on the same page, it doesn't really make sense to explain all of my strategies or some of my strategies, just because there's gonna be a gap between people who understand some but who don't, and the point is to learn together. So with that, I'm going to go over some of the things I use, and if you guys have a full understanding of it, you can just say yes or no, and if not, we can kind of go through them. I'm definitely not going to go through Ichimoku today because that can take 45 minutes on its own. But, are you guys familiar with MACD at all? You guys can just type in the chat or say yes.
Yes.
You guys know
Not
MACD?
enough.
I'm not.
Not very good. Okay, that's fine. We'll get there. All right. And what about a TTM squeeze? You guys are good with that?
Yeah, I'm good with that.
Good with that? All right, sounds good. And then RSI, relative strength index.
I know I'm gonna be the noob, but I'm just gonna go ahead and say it out there that I don't know any of this crap.
Yeah, that's fine. Yeah, no, don't worry. This is not for judgment. I just want to gauge where people are at. That's good. All right, RSI, TTM, MACD. Volume, obviously. Well, volume just shows how many shares are being traded between people. It's pretty self-explanatory. Higher volume equals more price movement, generally. What else are we looking at? I use so many indicators. Are you guys familiar with the Ichimoku cloud at all?
A little bit.
I'm not.
Okay, gotcha. All right. That's probably the most advanced and most accurate indicator of all time. Okay, yeah. Well, yeah, it's very accurate, very advanced. It doesn't give many signals because very few things are guaranteed in the market. But if the Ichimoku does flash all its signals, the only thing that can stop it is really news or a Trump tweet. So we'll go over that. And what else? What other common indicators? You guys know the EMAs, moving averages. There's just strategies with it. You guys can read up on those. I'm not going to go through them because I tend not to use them as much. They're just too slow for my taste, but they are good ways to confirm price action. All right, cool. So let's go over. Yeah, I guess we can go over. What do you want to do first, man? You choose.
We can do EMS.
EMS. All right. Yeah, so I guess we'll just do a little indicator setup before we actually go into the strategy because you guys don't understand them. All right. So EMAs, very simply put, EMAs show price action over a set period of days, right? So many traders use anywhere from 1 day EMAs to usually 200. I've never heard of anyone really using a 1 day EMA. The typical setup is a 21 or 20-day EMA and then 50-day EMA and a $200 EMA, right? Some traders like to use a 9-day EMA just for short-term price action, but I don't think it's really as helpful, right? EMA stands for exponential moving average, and all it does is just a line that will show you the moving average of a price over a set number of days, and it puts more weight on the more recent price action, right? That's all you really need to know. The actual calculation isn't really as important for this lesson, but just know that it's a lot faster than an actual moving average. So every single one of these candles has a mathematical average, and the average between the open and the close is going to be that point that these lines are taking to create the data for where the price is relative to the previous values of the candles. So in English, more recent price action will make these lines move or react more quickly. That's all. And then moving averages, also called SMAs, those lines just show literal price action, right? So if we take the averages between all the candles, it does not apply more weight to more recent price action, right? So if you have 300 candles that are all like at one price level, and then one candle, it drops like to zero, the moving average is actually not really going to move. But with an exponential moving average line, you are going to see that line move a lot because, like I said, it puts more weight on more recent prices. As far as strategy goes, generally, if you have your price above your moving averages, you are in an uptrend. And if your price is below your moving averages, you are in a downtrend, right? That's very, very, very basically put. The second thing you want to know about EMAs is whenever you have your smaller value EMAs crossing over your larger value EMAs, that is more confirmation of the current trend, right? So for example, if you guys are looking at the screen right now, which line is which, bro? The blue is 21.
Blue's 21.9 is
Green is 9. Looks good, 9. All right. Yes, if you guys, when I say the smaller time frame is crossing over the bigger one, I mean like a 9-day moving average is crossing over at 21 days, right? So 9 days is less than 21. So if your 9-day is crossing below your 21-day moving average, that is bearish, right? Because if your smaller time frame is crossing over your bigger time frame, that confirms the downtrend that you guys are looking at on the screen right now, right? And then whenever you have your smaller time frame crossing upwards above your larger time frame, that is confirmation of a bullish momentum, right? So I'll just get my pen so I can draw some things on the screen for you guys. I'm not sure where it's at. All right.
You can see this one is pretty delayed. The simple moving average is pretty delayed.
Yeah, the simple moving average, it gives you more accurate signals, but as day traders, by the time this happens, if you're waiting for this as an options trader, you're gonna get in like here, and you missed all that price action, right? That's why I typically don't like SMAs for short-term trading, just because it's too slow for my taste. You're not really gonna get anywhere unless you want to swing. But then again, in this market, these moving averages can cross over so quickly. So I do not like simple moving averages for day trading. But if you guys are trading stocks for your portfolio, moving averages are definitely something good to consider, right? Another quick note about the moving averages. You guys might have heard the term death cross and golden cross. Those are very, very specific conditions. It's whenever you have your 50-day moving average cross your 200-day moving average on a daily chart, right? That's a very, very special condition that happens. So you look on any daily chart.
Hold on 1 second.
Yeah.
I'm trying to add
Gotcha.
50 real quick.
Yeah, 50 in the 200. Take your time.
You can also see that this is the EMA. EMA is pretty little faster than the SMA. SMA was like over here. EMA is a little closer. 200 real quick.
Yeah, exactly. So that EMA actually would have gotten you in that downtrend a lot sooner than your SMA.
Right, and that's what we're using, right? The 9 and the 21 on the EMAs.
So yeah, the green is the 9, the blue is the 21, my orange is the 50, and then my purple is my 200 EMA. Let me go to
Also a quick tip, whenever you have your 200, if your price is below your 200 EMA, it's just bearish. Like I don't trade anything that's trading under the 200 EMA usually. Because to be under your 200-day average on any stock means it's probably a very, very bad stock, or something's wrong. Like a lot of things have to be wrong for you to be under your 200-day EMA, like coronavirus. So we're looking at BABA right now. What's this? All right. So if you have the regular moving averages on, the SMAs.
I have exponential.
Yeah, I'll put the estimates on just so I can show the golden and death cross real quick. Just need the 50 and the 200, I think.
SMA simple moving.
Yeah.
So you're saying below 200 under the daily time frame, right?
Yes.
Yeah. Or
Okay.
or honestly, any time frame above 15 minute. If you're under your 200, I would just stay away, or I'd be playing puts only on those, right? As you get to shorter time frames, then your 200-day moving average still might be pretty close. But then again, you generally don't want to trade stocks under the 200-day moving average in any time frame, generally. All right, this is a 15 200. All right, cool. So we actually yeah, go back to they're actually these stocks actually never crossed. Yeah. Check out SPY. No, yeah, look at SPY. That's a golden
Amazon.
cross right there. Yeah, it's a golden cross, and that's before March actually. Yeah. Yeah. So right there, it's a golden cross. Whenever you're 50 cross to 200, that is the beginning. It's like a sign that you're gonna have a very stable uptrend, right? And had coronavirus not happened, Amazon actually would have been moving up a lot, right? So I'm not really sure at which point these averages cross downwards, but you know, Amazon, this looks great for Amazon, right? And obviously, as you guys can see, after that golden cross happened, and if you ignore that coronavirus dip, you would have had a lot of gains in that stock, right? So
And that's on which time frame?
on the
Daily.
daily. So whenever someone says golden cross and death cross without saying anything else, they are talking about the 50 and 200 on a daily chart, right? SPY, same thing. Yeah, so there's a death cross that happened. I mean, that was obviously way too late. So,
Yeah.
I mean, I think any investor would have noticed the market was dipping before that, or they need glasses. But then that area in June, I think that's July 2nd. Is that the date? The eyeball that July 8th, right? In that area, that's when we kind of confirm that SPY would be back in an uptrend. So most investors probably started really entering the market after that cross happened. And everything before that was just kind of a COVID correction. And yeah, that's pretty much it about EMAs. My personal setup is I use for EMAs, I use the 9 sometimes, very rarely. I use a 21 all the time. I use a 50 and the 200, right? The 9 is kind of just my indicator for spotting when things are overextended. So if you have a stock trading way above the 9, then I consider it overextended and I look to short it short term. And then the 200 is kind of just it's just kind of what I watch to see where the price is, if it's in a healthy position, right? Very rarely do I have to deal with a 200-day moving average. And then as I was talking about the crossovers before, I always look at the interactions between the 20 and the 50-day moving average to kind of see how they cross over when they cross over. They cross all the time, especially on the 3-minute candles. So I always.
Okay, what about like when the 9 and the 21 cross? That's not really that important then.
It can be, yeah, it's like a signal. When they cross, you could just assume that there might be a bit of a dip or downward price action. It can be the beginning of a signal, and then if your 9 crosses your 21, and then it crosses your 50, and then your 21 crosses your 50, then at that point, that's when you definitely.
That's what I saw on Amazon on Friday when I jumped in that trade. Remember I was telling you I jumped in that Amazon trade, and you're like, oh, it was risky. I saw that like it was getting set up where the 9 crossed the 21, and then the 21 crossed the 50 on the upside.
At that point, you kind of want to not be in calls, because every additional signal you get against your trading plan is another reason not to go with your trade, right? Yeah, so that makes sense.
As an example, 9 cross 21 over 50 and over VWAP right here on SPY.
Right. Yeah, so that would have been a great trade. Yeah, so most people actually wouldn't have entered this trade until maybe around here, I'd say, that little area, just because that's the confirmation they're looking for in the moving averages. I mean, I got it like at the bell. I did say SPY calls at the bell because I saw the bullish momentum going up, but it's always better to go into trades that you're sure of rather than try and get in early and then get smoked, right?
So, Craig, quick question. You went in at the bell, right? Now you see that candle that came all the way down. What's that gold line right there? Is that the 20? Is that
Right
the
here?
two?
Oh, wait.
Yeah. Where you just circled when it came down through that line. What indicator is that? The 200 or
That's 200, yeah.
So that wouldn't like trigger you to say, "Hey, it's probably time to pull this out now," or like what would keep you in that call if you got in calls at the bell?
The only reason, well, honestly, I would have a set. It would depend on my support and resistance lines. That 200-day moving average wasn't as significant only because it didn't close below it. If that candle did close below, then I would look for another red candle for me to fully exit the trade.
So one other quick question to follow up. You're not really entering or exiting a trade until the candle's closed, correct?
Yeah, exactly. I want to see
All
how
right.
the candles form before I get in, right?
Gotcha.
So a lot of people will be like, when I say stop loss at this line, people will actually see the stock hit that level, then they'll get shaken out of the trade, and then they realize it goes up right after, right? Always wait for the candles to close. And if I don't say anything, I'm always talking about the 3-minute candles, right? That's a golden rule for day traders. Like, day traders tend to follow 3-minute candles. So although you're looking at the 5-minute candles before, and you saw that red candle dip below, on a 3-minute chart, this actually looks a lot less scary, right?
Hammer.
Now, had this candle been red on the 3-minute, I would have been a bit worried, right? Or like not a hammer candle. But since it was a hammer candle, it shows that we have a lot of price rejection right here. And we actually never saw that value again, right? So just look how the candles interact with the moving averages. And, the moving averages are lagging indicators. So if they don't lie to you, right? What the moving averages are doing, that's what happened. So you're not going to get any really false signals. It's just up to you to decide how early you want to get in the trade, right? Always wait for confirmation with moving averages. It's always better to get in late than to get in early and be wrong, right? All right. What else can we go over? Yeah, if we want to do like my setup for day trading, it's going to be a completely different class, only because we don't have time to go over everything. You want to go over TTM next, or MACD, or?
You do MACD.
Yeah, MACD.
Oh, 1 second.
All right. Wait a sec.
Now the MACD has just standard settings, right? Or you change those?
Standard.
Yeah, standard.
Hold on, I'm going to delete the other ones.
So MACD is just like using moving averages like 2150 and all those, right?
Not quite. The MACD uses one moving average. I think it's a 12-day or 26. I don't remember.
12, 26, and a 9.
Yeah, it uses them together. Give me a second. All right, so yeah, real quick, MACD stands for Moving Average Convergence Divergence. All that means is it will use moving averages to kind of confirm price action, much like the EMAs do. So what's interesting about MACD is that we have two main lines to watch. We have the actual moving average line, which is this blue line right here, right? On that blue line, if you're following it, right? That's your moving average. And that little yellow line right here is called our signal line, right? So basically, whenever we have our actual moving average cross that signal line, then we consider that to be basically bullish or bearish, right? That's bearish right there. This is bullish. That crossover is bullish. That's bullish, bearish, bearish, very, very bearish. And it looks like it's going to be bullish again at the end, right? And if you guys just stack that up with the actual price action, you guys can see that it's going to be usually pretty late, right? It's one of the slowest indicators, but it is very accurate. I just find it to be always a little bit too late with everything. But sometimes you can catch some nice price action with it, right? So as far as strategy goes, all it does is kind of confirm price action. So as traders, and I'll definitely go into more depth about this, but we always like to look at something called divergence, right? And basically, if we ever see something happening in our indicators that is not happening like with what we're seeing, we can always expect a reversal to happen pretty soon, right? This is a relatively advanced topic, which I'm not really going to go over right now, explaining MACD because it's not really directly related. But if you guys look at this chart quickly, yeah, I'll do this next time. I can't go over complete divergence trading right now. I'll just finish in MACD since I started that already. Basically, if you ever see something that doesn't really match up with your MACD, you can probably tell something's about to happen. Meaning, if you see price going up right here, all right, and you see the MACD crossing down right here, you can probably expect some more pullback. Now, SPY did not pull back, but that could be like a quick way to maybe scalp some puts right there, right? I have to look at exactly where those lines were. I don't know. You guys will see. I'll show it to you in real time. As we're trading, I do draw it up all the time. The second thing you want to look at for MACD is this little histogram right here. That's what these little green and red bars, right? All that's showing you is how much the signal line and the moving average has diverged, right? So remember I told you MACD stands for moving average convergence divergence, right? So
Yo, Craig, just real quick question. When you have MACD set up, that also gives you that the TTM indicator also, or is that separate from
no,
the TTM
it's
street?
separate, completely separate indicators.
So what are those indicators that are green and red on the bottom right there?
This is just a
No,
histogram.
That's histogram I'm talking about.
Oh, okay.
Yeah,
So,
I mean, I know
when you set up a
TTM looks a
MACD,
bit
it has
like
a
that.
histogram also?
Yes.
Gotcha. Okay.
Yeah, this I know it looks like TTM, but they are not at
They're
all
not
the same.
yeah.
These have nothing to do with each other. All right.
Could you just go over how to read the histogram on this?
Yeah, that's what I'm doing right now.
All right, nice, brother.
Yeah. So like I said, MACD stands for moving average convergence divergence, right? So this histogram right here is showing you how far apart these two lines are, right? So at any given moment, right? So right here, you guys see how those lines are far apart. That histogram is showing that's the exact same thing, right? So it doesn't matter how high or low these lines are in the graph. All of this histogram is showing you is how far apart these two lines are at any given moment in time, right? So if you see your histogram spike up like this, you can probably expect a reversal pretty soon, because that means that you're kind of getting a little bit overextended, and it also it's kind of showing you momentum as well, right? So like right here, sorry, this pen is not working. Right here, if you match it up, you probably could have caught this downward price move had you guys seen how quickly it spiked up, right? The MACD likes to stay close together relatively. So whenever your histogram gets above certain values, I don't really have numbers for you guys, but like, on this chart, MACD stayed for the most part below 0.05. That's the divergence indicator, right? It's showing you how far from this middle line is. So anytime this MACD went over that level, some severe pullback followed, right? So that would have been a false signal right here because it kept running. But here, for example, we saw a pullback right there. Here, we saw a pullback right there. Here, we saw not much going on. And then here, we definitely saw a lot of pullback, right? So you guys can even draw like support and resistance lines on your MACD histograms just to kind of get an idea of, where you can have oversold price action or overbought price action, right? You guys can use it in combination with RSI. Just remember, MACD is the slowest indicator in the market, probably. It is very accurate, but it will get you in trades pretty slow.
Yeah, like an indicator.
That's pretty much, yeah. So that's pretty much it. You guys can go to Investopedia to kind of read up more about the histogram of MACD. But like I said, all you really need to know is whenever that moving average crosses your signal line, that's kind of a signal that we're gonna have that you're in bearish territory, right? So even if your price keeps rising and your MACD crosses downwards, that's the biggest signal to get out of your trade, right? So I'm not sure how this matches up. I'm making it as straight as possible. That right there, you're increasing price and you have your MACD histogram going down. That is an indication to get out of the trade, and that would have saved you from that little downward trend right there. I mean, I know it's pre-market, but just an example.
Yeah,
But
so
kind of
What do
make-
you recommend that would be beneficial to getting quicker results or quicker responses out of these things here?
You're not going to get any quick response with a MACD. The MACD, all it's going to do is show you, it gives you a bigger picture of what's going on. So most traders always want to use a MACD in combination with another indicator, like RSI, to kind of confirm. I mean, like I said, since I have to explain this to you guys, the actual indicators, I can definitely go over the strategies in next class because we're kind of running low on time right now. But I can't teach you guys strategies if you guys don't understand the indicators fully and how they actually work, right? So yeah, definitely do some reading on this. I mean, I can't explain to you the entire theory behind it in 10 minutes, obviously, but you know, volume, RSI, and MACD are always used together. Moving averages and MACD are also, you know, MACD is one of those things that you always pair with something else, but you don't really use it by itself. And yeah, that's pretty much it, guys. Yeah, if you guys RSI, I'll do that very quickly because I can do that in 30 seconds. RSI is just an indicator that shows you if something is overbought or oversold. So anything over 70 is considered overbought, and anything under 30, I don't see it here, but anything under 30 is considered oversold. So if you guys can normally short things that have a high RSI and buy things with lower RSI. But then again, it's not going to be that helpful because things tend to stay between 70 and 30 for the most part. So yeah, that's pretty much it, guys. If you guys have any questions, you guys can put it in the mentorship tab and I'll try and get to it as soon as possible. But, you know, I have been on this for a while, so I kind of do want to, you know, just chart for tomorrow, and I'll see you guys pre-market, all right? Hope you guys learned something.
Thank you.
Yep, no problem. All right, good night.
Thank you, brother. Good class. Thank you.
Good night.
I'll see you guys. I do my watch lists.